Good morning. Thank you, everyone, for joining us today. I'm Bertrand Renazet, Chief Market Intelligence Officer at Viodios AI. Viodios AI is a data intelligence platform for carbon markets seeking to increase transparency. I'll be your host for today. Today we'll be diving into the US market. We'll be looking at some of the specificities of the market and related topics, such as the compliance market, as well as the Inflation Reduction Act. We'll make sure we keep the last 20 minutes of this webinar for question and answers. But feel free to log questions throughout the webinar using the Q&A function in Zoom. You should have it in your toolbar at the bottom. Also, at the end of the webinar, or whenever you leave it, you'll be prompted with a quick survey on the voluntary carbon markets. It's only 8 questions. It shouldn't take more than 2 minutes for you guys to fill it up. So a big thank you in advance for helping us understand what matters in this market for you. But without further ado, let me introduce you to Andrew Lichter, VP at Möbius Risk Group. Hi, Andrew.
Hey, Bertrand. How are you?
Good. Excellent. Thanks for joining us today. Do you mind giving us a bit about telling us a bit about your background and telling us what exciting things Möbius is working on?
Sure. So first off, thank you, Bertrand, and the Viodios team for having us on today. And thank you to everybody out there, old friends, new, and people I haven't met yet for joining us today. The U.S. carbon markets are really kind of its own animal. So it's got a lot of crossover, but a lot of unique attributes to it, both in terms of product and regulations and general philosophy that corporates and industrials have here. So as you said, I'm Drew Lichter, VP of Corporate Strategy at Möbius Risk Group. We are a commodities and risk management advisory firm. So we focus on both physical energy commodities, renewables, as well as metals and mining. And I lead our metals and our renewables practices. So we basically sit as an in-house trading and risk management team, quantitative analytics, fundamental analytics, marketing, trading, structuring for commodities producers, processors, and end users, as well as their capital sponsors. So that's where we approach the markets from. My background is in commodities trading. I started off as a member of the board of trade. I'm, as far as I know, the youngest person to trade with hand signals that I know. Started off, then moved upstairs and wound up at Royal Bank of Canada as director of commodity options trading, and also helped scale up the carbon trading business there. So that's where I first got introduced to carbon markets, to structuring and options trading, both in global compliance programs such as the EU ETS, as well as voluntary markets. So that's where I come from. I've also spent some time working in the industrial space as a finance executive and trading executive, within steel production, and I've been at Möbius about 4 years. So excited to have a great conversation. We've been longtime fans of Viodios and customers and friends. So yeah, excited to have a great conversation with them.
Thank you, Drew. Yeah, no, it's true. Actually, I should have mentioned that. I think Viodios and Möbius have been partnering on carbon markets for at least 3 years. I think that was fairly at the beginning of our carbon journey. So yeah, very excited to have you here. And so let's start by maybe by setting the scenes and looking at the background. What differences do you see in terms of decarbonization effort between the United States and Europe and the APAC region?
Yeah, so I kind of think of the United States, and Canada is kind of a hybrid, but the United States relative to Europe and Australasia, ASEAN. So we think of it in terms of, and it's kind of a 1.5 degrees Celsius for the rest of the world versus energy transition here in the US. You don't hear 1.5 degrees Celsius all that often from US industrials and corporates. You will from climate specific people, whether it's a chief sustainability officer or a climate risk officer, you will hear it. But in the broader C-suite, generally, it's more focused on energy efficiency, energy transition, and decarbonization. So it's the words that people use kind of also will frame what their actions are going to be, right? The words reflect the actions reflect the words. So you see a lot of engineered solutions coming into play here in the U.S. around carbon capture, around hydrogen, around abatement of oil and gas wells and early abatement of oil and gas wells, and cutting down flaring and some of the different things that can happen, as well as transition to natural gas. I know there's a lot of disagreement around this. We're big believers that just fundamentally natural gas needs to be a transition fuel. And when you can take 60% of the carbon out of power production, and you can do it at scale. This doesn't mean we shouldn't be doing other stuff. It doesn't mean you don't look at renewables, but it does mean that, hey, until we can be 100%, green energy, we need to be accepting of stuff that's kind of in the middle. And I think that's also more of an American point of view. Obviously, there's a lot of people in Europe who would agree, especially these days if the winter gets cold. But that's a major difference. Whereas in Europe, people are really talking about it from a climate perspective. Even in the C-suite, that's been our experience. It's less so in the U.S. More engineering and decarbonization would be the big philosophical differential. And then just the way people view those decarbonization efforts. I think there's probably a more energy accepting view in the United States towards fossil fuels. Not that people necessarily love them, but most people accept, that, hey, we're not going to move away from oil and gas production tomorrow. We probably shouldn't. It's really about how do you transition intelligently towards a lower carbon future, right? So you'll hear people talk about low carbon solutions or lower carbon solutions as opposed to green solutions, right? So that would be probably the biggest difference as far as philosophy. Then obviously, one of the big differences is we have no ETS that covers the whole country. There's obviously programs regionally. We've got a lot of different programs that exist within individual power grids, individual states, et cetera, both as far as low carbon fuels, low carbon power generation, as well as cap and trade. But there's nothing nationally. So that would be the other big difference relative to say either Australia or the EU, which both have their own programs.
Yeah, absolutely. And then, I mean, I'm stating the obvious, but Europe is not producing a lot of fossil fuel anymore these days. So that's also, and that explains a lot of those drivers. I mean, US is still a very big producer of energy today. So.
Yeah, which is one of the reasons we're seeing industrial production shift to the U.S. Because some processes, no matter what we want to do, they're energy intensive, right? If you want to create ethanol, it's energy intensive. If you want to make steel or aluminum, it's energy intensive. The goal is to get it down, but there's no scalable process in place yet to really do it on a zero carbon basis. We're just not there yet. People are investing into that, but we're not there. So yeah, I would agree.
Yeah, thank you. So you touched a bit on the EU ETS, so the EU emission trading system. So that has been created as early as 2005. Probably also because I'm a European based in Europe. I'm quite familiar with how it works. What are the sectors covered by the ETS? It's at first glance a little more difficult to understand, how these cap and trade systems work in the US. And, maybe we start with something very general. Why is there not a nationwide ETS in the US? And what are the alternatives? What are the programs in place? How do they function?
Well, I mean, not only do we not have a nationwide ETS, we have individual states actually making laws and regulations to kind of attack each other and enforce their political view. And we see that on both sides, right? So when you have, one state that requires, and I'm kind of exaggerating a little bit here, but one state that requires you get rid of gas stoves, and another state that requires that you have to have a gas stove, or you can't make, for example, there's a bill in Florida that you can't use any qualitative measures in investment decisions if you're running money for the state, right? So there's bills on both sides, and to get those two sides even to come together on any kind of compromise is really, really difficult. Here in the U.S., I mean, we've got to put it in a broader perspective to show kind of the political dysfunction, and we're not necessarily any worse than any European country as there's political dysfunction most places, but we've got, right now what's going on in Congress everyone believes we have to do something about the border, and everyone believes we need to do something, or most people do, to support Ukraine, but they can't even come to a compromise where you'll make some incremental steps here to do some incremental steps here. So the odds, in my view, of a nationwide cap and trade system anytime in the near future in the US, I think it's really, really slim. I just don't see it happening. And especially when you have the side of the aisle that believes that we should have one, also is very suspicious of the energy companies and the financial companies who by and large are the participants in a cap and trade system, right? And the people that are supportive of maybe those industries, we have everything from climate change deniers to people who, don't deny it, but also, don't necessarily believe that a cap and trade program is the best way to go. I personally think cap and trade works. We had one of the first cap and trade programs around particulate emissions, the SOx and NOx trading programs that I believe came about in the 80s, early 90s, or before my time when they started. But it effectively got rid of all the sulfur dioxide and nitrous oxide that was in the air that was causing acid rain. So my kids don't know what acid rain is. I remember the articles in the 80s, when I was growing up, right? And cap and trade got rid of it without driving power prices through the roof, like people, some alarmists said. So I think it works. But I don't see us having a nationwide program anytime soon.
Okay. And so right now, at the moment, we have basically RGGI, which is going to be covering the Northeast of the US and then California. Yep. Is there more than that?
Those are the big ones. And RGGI is just the Regional Greenhouse Gas Initiative is really just for power producers. So it's less of a pure cap and trade and more of almost a renewable portfolio standard. But California is it is by far the biggest and most comprehensive cap and trade system, here in the country. It's modeled very closely on the EU ETS, even down to the perspective of you can use offsets, just like you could use offsets in the beginning to do a portion of your compliance. In the EU, you can use offsets for a portion of your compliance. In California, as long as they're certified. But it's very similar. It involves industry as well as power generation. The issue that they have there is there is no carbon border adjustment. So the really smart thing that the EU did is they allocated all the allowances to companies in global industries, right? So like steel and aluminum, just as two examples that you can easily export. They gave the allowances to people in the beginning. Now they're going to make them auction it, but there's a carbon border adjustment. Well, California doesn't have that. So when you in essence make it more expensive to manufacture there, and somebody can just go across the border to Arizona or Texas, that's actually that's the issue that they have. Other than that, it's a fairly well-designed program. They've got their low carbon fuel standard that's rolled into it. I mean, there's a lot of different aspects to it. But the issue that they have is that they're not a independent entity, right? But other than that, it's a fairly, very liquid and fairly well-run program in my view.
Yeah, thank you very much.
I guess the big one I think we should touch on. Sorry, I meant to say this and got myself talking and forgot what I was going to say. But we've got a lot of individual renewable power standards that exist in all the states. So you'll see offsets get mixed reviews here in the US, but renewable power, whether it's in the form of a renewable power purchase agreement or a virtual power purchase agreement, which I won't get into the details around that, but those are very well accepted. So you'll see a lot of companies right now, whether it's corporate, industrial, travel, et cetera, they will use renewable power towards their scope 2, which is your power generation emissions for those who aren't familiar with the terminology. But there's different standards that exist everywhere. So renewable energy certificates, which are the renewable attributes of renewable power. Because keep in mind, with power, you sell to the grid, you pull out of the grid. You don't necessarily know what you have right now, right? So I might be on renewable power right now. I might be on coal. I don't have any idea, right? And neither does a steel mill down the road, neither does a factory down the road, neither does a data center down the road, right? And so they split out the renewable attributes, and those trade very actively, right? So people will go after those, and those can be voluntary or they can also be compliance. And they tend to trade actually not too far off the price of quality offsets, at least for the voluntary side, but they are priced in megawatt hours if you see the price on it. So,
okay, yeah, very interesting. And coming back on the some things that we are is important for us on our platform is we display the so-called ARB, so offsets which are eligible to the California compliance market, and that's actually a very interesting path, because, like you said, this used to exist in the EU ETS. There was some fungibility with CDM project, but it doesn't exist anymore. And I think I would welcome something like this in the EU ETS again, because I think it creates some standardized kind of demand rather, and this way you help the market to slowly move away from being purely voluntary, which as we've seen in years like 2023, when you've got scandals, and you have a lot of end users, corporation will tend to stay on the sideline, wait for the bad news to move. So yeah, very, very, very interesting. So with Viridios AI, we've been we are actually launching. We are about to launch some data sets around who is retiring carbon credits, so the so-called retirement data, and we've been doing a bit of analysis on which American corporation is retiring. Katie, that's not yet. That the slides are going to be for a bit later, but sorry. And we've been looking at, and so when I was crunching data for American corporation in for retirement data, I could see basically global tech, airlines. Then a bit of entertainment industry, the Netflix, the Disney of the world, and that's pretty much it. So, what can you tell us? How do you look at the voluntary carbon market in the US? What are the pockets of buyers, and in terms of project types, well, what are these corporations looking after?
Yeah, so I think we're seeing a big shift going on in the market right now, where historically the buyers, to your point, were the big tech companies. They were printing money, they were doing really, really well, and this was just a nice thing that they kind of did. And they're also big energy users. When people don't get there's a lot of electricity that goes into a data center, right? And as we move more and more towards AI, it becomes even more and more energy intensive, right? So they're trying to get ahead of that and do the right things around that. In the hard to abate industries, in the industrials, transportation, et cetera, airlines have historically been big buyers. We're seeing them start to pull back right now to a degree. They're still in there, but they're looking more at sustainable aviation fuel is the big thing that they're looking at right now, which is great. I don't know how much scale there is to it, at least with current technology, but it's obviously a wonderful thing. For those of you who don't know, sustainable aviation fuel is the same chemistry as traditional jet fuel. It just doesn't have the impurities, and if it's done with waste cooking oil, for example, it's a very green process, not 100% green, but much greener. And I've had a couple of people say, well, I don't want to get up in an airline that has it's running on used cooking oil, and it's like, no, it's actually the same chemistry, right? And so what we're seeing a lot in the industrial space kind of follows what the airlines are starting to do, which is it's not that they're not interested in offsets, it's that our industrial capacity tends to be run by people with engineering backgrounds and operational backgrounds. There's some industries that you get a lot of bankers in there, investment bankers in particular, but by and large, it's if we're talking oil and gas, or we're talking steel making, or we're talking petchem, it tends to be engineers, and people tend to move towards solutions that they're most familiar with, right? So I'm a trader. I tend to look towards market-based solutions first because that's what I know. You get an engineer, they tend to look towards engineering solutions. So you might not see the offset interest from some of these folks, but you do see a ton of interest in terms of carbon capture and storage, hydrogen, direct air capture, I think, is a little bit further out, but cogeneration, energy efficiency, everything along those lines, we're seeing a ton of it. So I think the big contributor to offset growth in the U.S., and this is opinion here because this hasn't happened yet, but there's all these carbon capture projects that are coming online, and we think there's going to be, and this feeds into the Inflation Reduction Act as well. We think there's going to be opportunities for carbon finance to monetize some of those opportunities. But we see the engineering solutions being kind of the U.S. The U.S. supply that comes online. much more so than some of the nature-based, here in the States. We tend to be more provincial in the sense that we want to invest in projects that are here in the U.S. more so than in Indonesia, for example. Whereas people in Europe and Australia in particular tend to view themselves as more global, partly because people in Australia, by and large, if they're educated, they've traveled the world. I would bet that if you take educated Australians, the vast majority have been to the U.S. at some point. The vast majority of educated Americans have not been to Australia. And certainly have less experience generally living abroad. So that's so I think the engineered solutions are going to be kind of the U.S. contribution, which I think is going to be a really good thing, because you need that, that hydrocarbon expertise to do carbon capture and storage. It's not going to be tech companies that do it. It's going to be oil and gas companies, and same thing with hydrogen. So we see that as being kind of the U.S. contribution.
Okay, thank you very much. Yeah, I mean, you were just echoing what you were saying on the airlines. I was looking at the retirement numbers for Delta Airlines, for instance. So who have made it clear and publicly available that they are sort of withdrawing from the voluntary carbon markets after the scandals that was in the press. But just to put some numbers, we were looking at 350,000 tons purchased in 22, and for 23 we see only 20,000 in the registry. So it is it is a big a big shift. Katie, can I trouble you to flash the screen? So we're gonna look at 2-3 charts pertaining to the VCM in the US. So that slides which are published on LinkedIn a couple of weeks ago, that's interesting, because I mean it's fair to say that a lot has happened in 23, and as we know, the retirements in volume are down compared to 2022. But then I wanted to look a bit registry by registry what's going on. And the picture, I was not anticipating this. So we do see a big drop for Vera, which is indicated as VCS here, and that's about minus 14%, 1/4. But if we look at the tree as a big registry, gold standard, not so present as I understand in the US, but then CAR and ACR, which are very big in the US. All these three registry have quite a big increase year on year from 2022 to 2023. Especially, I think it's worth mentioning that CAR has an increase of 72% from one year to another, so which is exceptional, and it means that on the ground and something around carbon credits is definitely happening in North America. Let's go to the next slide. Yeah, so here here I've not limited to it's not broken down by registry, but more by I've applied a filter on US, Canada, and Mexico located projects, and then basically I look at the project types in number of tons of TCO2 retired. And so yeah, as Drew sort of highlighted earlier, by and large, we have like 1/4 around nature-based solutions. So that would be your improved forest management, biggest part of it, and then a bit of afforestation, reforestation. Also, I would bet that a lot of that must be in Mexico, but I would have to check. And then 3/4. And we see the trend between 22 to 23, right? So it's the part for gases abatement, as it used to be 3/4, and it's even a little more in 23. And it's also, the volume is quite interesting. So we observe like 35% issue retirement more, from one year to another. So, all this goes into the right direction, despite the general backdrop on the voluntary carbon markets. Next. And yeah, and this is quarter by quarter, the evolution just for car and ACR projects. So yeah, we see that actually what I was describing as like the big shift for ACR. No, sorry, for car is the bulk of it happened actually in first quarter 2023. I mean, and I've been looking this morning at the press to see if I could correlate this. I couldn't find anything. Would you know by any chance what triggers this sort of not abnormally, but this larger retirement in first quarter? No.
No, I mean, I'd have to go back and look. I haven't done any look behind it, but I mean, obviously, what we see over the last year with the shift is you've got a market that's not necessarily shrinking, but Vera is shrinking because all the attacks that they got, right? And some of that was probably justified. Some of it I thought was ridiculous. The idea that they're privateers or the project developers are privateers is just not true. These are people that are not doing it for the money. It's public what they get paid. They're not in it for the money, right? There's a lot of places that you go make a lot more. That said, some of the Red Plus projects in particular, as we go through this really new process, they weren't necessarily baselined as well as they could have been, right? And they weren't necessarily measured and tracked as well as they could have been. And we're realizing there's a lot of externalities that can impact what happens there, whether it's an election or a natural disaster or forest poaching, whatever you want to call it. There's things that impact this, right? And at the end of the day, when you're sitting here in the US and you're going to get attacked from one side just for buying them, and now you're going to get attacked from the other side for buying them, why would you do something that you have no regulatory obligation to do that costs shareholders money that's going to result in negative PR? I mean, you wouldn't do it, right? It doesn't make any sense. And so, that's what we're seeing there. And you see the same thing if we look at what we've seen over the last year. It's not that prices have gone down. I mean, they're maybe down a little bit. But they're generally what we're seeing is the spread between the quality projects and the projects perceived as low quality have gotten killed. So if you look at, let's say, the CME futures, for anybody who watches that, those were not designed very well. I didn't think they were designed well at the time. Then they started really trading well. And I said, well, maybe I was wrong on these. And now we're seeing when a lot of quality nature-based projects are still trading for, 15 to 30 US dollars, right? But if you look at the nature-based futures contract, it looks like they're trading sub $1. And that's because they're cheapest to deliver. They're physically delivered. You can deliver whatever meets the minimum standard into that. So you've got some of the lower quality Red Plus projects that have by and large been written down to zero that are being delivered against these futures, or other nature-based projects delivered against these futures. And they're not really what anybody wants. So we're seeing that quality spread expand. And obviously, because a lot of those projects tended to be, that are now considered low quality, tended to be on Vera, they've been obviously caught up in that. Like I said, there's some fair criticism, but I found a lot of the journalism around that to be lacking in facts and really lacking in a coherent opinion as well.
Yeah, no, thank you for that. And yeah, I mean, obviously, a lot of work has been done on improving methodology, reviewing more, and moving more towards things like dynamic baseline. But some more improvement will be required. And I think it's fair to say that we live also in a very sort of data-heavy kind of world, and the expectation of today is not the expectation of 20 years ago. So we will. Digitization of the carbon credits, so we'd get full transparency from issuance all the way to retirement, having everything digitized, the monitoring report, the verification. I think that's going to be key to increase trust into this market, because there's something very specific to carbon credits is it's not visible, it's intangible. So, whereas you deliver a ton of steel or aluminum, everybody can see it. Carbon is kind of virtual. So to make up for that, I think the use of DLT blockchain technology and fully digitalized will become essential.
Yeah, I mean, I think we're gonna see it all move to the blockchain, whether it's, kind of an overlay on the existing registries or a new blockchain-based registry. I think we need to see that because that just makes it just so much easier as far as getting a project down and verifying a project and allowing for the open source validation of this stuff. The other thing I think needs to happen is the not-for-profit structure, and I'm going to make any registry people on here probably mad at me, but that's okay. I've told them this before. The not-for-profit structure of registries is not going to work. It either needs to be a government entity that's leading it, a government or a government type organization that's leading it, or it needs to be for profit. And the reason for that is one of the issues that I think we saw with Vera in particular over the last couple of years is the scale of projects and the scale of interest that they had coming in grew so exponentially, and they don't have the capacity to to scale in the same way that a government can just decide they're going to spend money, or a for-profit business can turn around and raise capital. You can't raise that capital into it. So if the Intercontinental Exchange or the CME Group wants to expand, they can raise money to do it. If they suddenly have their volume double overnight, they can add the 20% or 30% more cybersecurity and et cetera that they need to add to support that. Whereas a not-for-profit can't. So it went from taking, a few weeks to get a registry account set up to a few months. And they just didn't have the staff. And when it's getting that slow, you're also it's gonna be difficult to really validate everything to the extent that it should be as well. I think that's a challenge, but that's my opinion. So sorry, anybody, I just
No,
made
no,
angry,
no.
but
Thanks,
it's what I think. So.
Thanks for sharing your views on this. Katie, maybe I think we are done with the slides, so maybe we can stop sharing. Moving on a bit onto the IRA. Don't know why I can't get this right. Inflation Reduction Act that was, if I'm not wrong, passed in 2022. So how do you see the impact of that bill on the carbon market in the US, and specifically on technology-based solutions for removal?
Yeah, so I mean, we've seen interest in CCUS grow. I mean, I couldn't put a number on it, but from a handful of calls a year to to more, we get more calls in a month about that now than we did in a year 3 years ago, right? And that's because at $45 for 45Q, which is the tax credit against carbon capture, and that's what it was before, it was $45. And there's some stuff around that was the max. It's economical for ethanol production. It was not economical for anything else, right? So what you saw a big project that's still in the process of potentially being developed through ethanol country, and out, I believe, to the Bakken to put it in the ground. But now at $85 is what the Inflation Reduction Act did. All of a sudden, it's economical, or at least borderline economical, for a whole lot of other industries. So steel making, aluminum smelting, pet chem, et cetera, all are either in play or potentially in play for that stuff. So I think we're going to see and we are seeing massive growth in carbon capture. And we're also seeing new investment in direct air capture, which had subsidies, raised meaningfully too. It's still not quite at the level where it becomes maybe economical standalone, but it becomes an easier lift to put a portion of capital into. So we think it's a game changer in a lot of ways as far as the engineered solutions, particularly on carbon capture.
Great, thank you. And then maybe just to close on that chapter, so you touched on this earlier on the the European Carbon Border Adjustment Mechanism, short form for CBAM. And we were talking earlier, and it seems that that's something that Europe has done particularly well, because it seems to have inspired. We are now reading Australia is looking at implementing a CBAM as well. Maybe the US one day. Also, as you alluded to, we're probably still a little far from that. But how do you so if we take a step back, I think the US is the 10th exporter in Europe. If we look at the product covered by the CBAM, most of the production which are under the CBAM scope are iron, steel, and aluminium. How do you see the situation evolving? Do you think it's a threat for American industry and trade, or how do you look at it?
So I actually think it's a huge opportunity for American industry and trade. And I think it dovetails well with some other macro factors that are influencing the world right now. But what the carbon border adjustment does, for anybody not familiar with it, is because the easy to export and import industries in Europe will now be required to purchase their EU allowances. And this starts in 2026 and it's scaled in over 10 years. But they're going to be required to purchase them. So therefore, anyone exporting to Europe is going to have to pay the same price that the European firms will. And the way it gets set, it is a direct correlation to the price of the EU credits. So EU credits right now, I want to say they're around $80 a ton. I haven't looked in the last couple of days, but it's basically whatever the prior week's average was for the EUA credits, you're going to pay that as an import duty. And the reason I think this is actually good for U.S. producers in a very big way is, let's look at steel just as one example. We're, I want to say, about 60 to 70% EAF production, which is scrap-based steel production. The rest of the world is far lower. Scrap-based, even when you include the metallics, which they like to not do that to make it look even especially good, but you include the pig iron, there's still going to be a ton or less of CO2 per ton of steel that they produce. And if you look at the blast furnace-based steel making here in the U.S., it's still some of the cleanest in the world, right? So we compare it to a lot of and when I say Asian mills, I'm talking China and Vietnam and India more so than Japan and Korea, which have similar carbon profiles to a U.S. mill. But in the, call it the developing world that's using iron ore fines, they're using much more coal, they're using less natural gas, whereas we use pellet, we use natural gas, we use DRI, it's just much cleaner. And we have a cleaner electricity grid. You're going to see about a 1 to 1.5 ton differential on carbon versus carbon from Vietnam, for example. And I'm not in any way picking on the Vietnamese; they make good steel, but it's just a more carbon intensive process. So if we're talking about an $80 a ton carbon price, we're talking about an $80 to $240, depending on what mill we're talking about, cost advantage for a U.S. producer versus Asian. Is that enough to shift trade flows? I think it is. To some extent or another. So we're not big exporters to Europe right now, except for some specialized products. I think that's going to change. And I think the CBAM actually, when we're talking about industry in the US, which of the developed world, we have some of the greenest industry out there. We have one of the greenest electricity grids, et cetera. I think we're going to see, that, and then the energy cost advantage coupled with that, we're going to see a shift in trade flows.
Thank you very much. And that completes what I wanted to discuss with you. I think I see on the chat we've got quite a number of questions. So, Katie, do you want to read a couple of questions?
Yes, thank you. Okay, so Randy asked the question, the use of RECs is well accepted against Scope 2. Could you share some thoughts on the use of offsets against Scope 3 emissions?
Well, I think if we're talking about Scope 1 or Scope 3, Scope 1 is being the emissions that you produce yourself, Scope 3 being the emissions in your supply chain, which for most people is going to be upstream from them in the energy production. For some people, say an iron ore mine, it might be downstream from them, where most of the emissions happen when it actually gets processed. But I think when you're talking about using offsets for that, and we've been saying this for years, and I think it's becoming relatively accepted, you've got to take the steps that you can take internally before you start looking at offsets, right? So this is actually, even SBTI, which tends to be, not necessarily aligned always with how I view the world, but they're even saying now, like, look, you can do it, but you've got to be taking the right steps, first. So if you just run the least efficient, operation you can with no concern for environmental good or social good or anything, and then you buy some offsets with a bunch of co-benefits and talk about how great you are, you're better off not buying the offsets, because you're just opening yourself up to attack, right? But if you've already done everything you can, let's take an airline. The airlines all want to decarbonize, right? But they can't decarbonize by grounding the planes. I mean, I guess they could, and I think that's what some people probably want, but I don't think it's where the majority of people's heads are. So if they've already invested into as much fuel efficiency as they can do, right? They've lightweighted their planes. If they've already invested into as much sustainable aviation fuel as they can, if they're already investing into potential electrification, they're already investing into potential direct air capture, but none of that stuff is going to get them carbon neutral today or tomorrow or probably in the next 15 years. So at that point, are they better off doing nothing versus buying a quality offset? I would argue absolutely not. quality offsets do a ton of good, right? So that's really what they're there for. They're there as a transition tool, and they're there as a balancing tool in the long term. I don't think this goes away. I disagree with some people who say this is a transition tool and then we're going to be done. We're never going to move completely away from carbon, right? If we talk sustainable aviation fuel, which like I said is great, it's still got 10 to 20% of the emissions of traditional jet fuel when you look at it on a life cycle basis. It's the same thing with most stuff, right? Renewable power isn't 100% green. So it's what do you do about that residual stuff? And we just think about it as, if you've done all your organic growth already, like I've grown everything I can organically in my business, just looking at it from a corporate perspective, then I can look inorganically, right? I look for M&A, I look for opportunities to acquire companies. But and I think it's the same thing with carbon, right? You got to earn the right to acquire companies by running a good operation. You can't just look at it as as an accident. Same thing with offsets. You got to earn the right to use them. But at a certain point, you've done what you can, and you got to invest externally to get to that next level.
Thank you for that. Katie, do we have any more questions?
Yes. Yep. Thank you, Drew. The next question is from Thomas. What are your thoughts on digital registries? Remote sensing, machine learning, smart contracts, and off-chain oracles have the ability to replace a large portion of the analog registration and verification process. So what are your thoughts?
So I think we got to separate it into two groups here, right? We've got the blockchain, right, which I think makes a ton of sense. And one way or another, we're gonna all be. I think most contracts are going to be on a blockchain in 10 years, and I think carbon registration and offsetting really lends itself well to a digital registry, because really you put the same controls in place that a typical registry would have. The difference is that rather than having to call somebody and have them email you documents, you can just go and click on the blockchain and see it, and nobody can change it once it's on there. You then also have some of the crypto things that are going to, and they're going to make a crypto coin out of carbon, for example. I've seen a couple of those, and I don't put a lot of stock in those. I think they're not going anywhere. But blockchain, yes. Crypto, no.
Yeah, and then there was the other aspect, which is there's the sort of the registry infrastructure, but there's as well using model technology, IoT, LiDAR, satellite imaging, and remote sensing for basically moving into digital MRV. And I think that's going to be key, because that will not only help us to have sort of more accurate data, but also more timely. What we've seen in the past is that the issuance process, and I'm just talking about something I'm very familiar with, which like nature-based project, you had to send your teams into the forest, do tons of measurement. And so you would only do that once a year, because economy of scale, it's it takes a lot of efforts, and then you need to check your data, validate it. We are slowly going to move with technology to be able to do issuance more frequently. I would say quasi real time, and that will also allow us to have larger scale project. Like if you look at that nature-based projects, so the project which were reducing emission for beyond 2 million, they are not that many, because it's in today's ways of working is such an undertaking to do the issuance for such a large project, and some of these projects are actually part of the project are very difficult to reach. So you need to make all sort of assumption in your measurement, in your use of allometric equation. So moving to remote sensing technology is going to be a way to really explode and scale this market. And that's the way I look at it. So.
Yeah, and I think it's true for nature-based. It's also true, we're seeing a lot of that in methane management in the U.S. oil and gas industry, for example, right? Where the midstream companies that own the pipelines, they have satellites or fixed-wing aircraft that are actually going over and looking and seeing where the leak's coming from, so they can plug them. So no, I think that technology is going to be essential, and I think that lends itself to what we're talking about too, with kind of getting the infrastructure in place, either through a government or for-profit entity to do that. I think it's going to be really important, because you've got some of these, some of the register budgets are in the 7 figures or maybe into 8 figures. that's not enough to really invest in, you know, in that kind of stuff. It just isn't. And it's also not enough to invest in the number of people that you need to go look at a 200,000 hectare project. I mean, that's a lot of land, right? To be looking through. It's a lot of land. You can't cover it in 2 days. You need a team of 1,000 people to cover it in a week, right? So it's how do we get to where nature-based will never have the same level of you know, engineered
precision,
perfection
always, yeah.
of some other things, right? But we can get it, I think, to a point where it's materially correct always, right? And that needs to be the goal, that it's materially correct. You're not going to be 100%. It's impossible because we can't predict the weather. We can't
Yeah,
predict a whole lot of
obviously the
things.
goal is not to have remote
but,
sensor in every part of the rainforest. I mean, that
Yeah.
has to
But
remain
you can get a
nature,
good, you can get a good idea between sensors and satellites. You can get a good idea of what's going on, and I think it's where it needs to go.
yeah,
And I
very
think it's
true,
where it's
very
going.
true. No, I'm
So-
excited about this progress and this development in for nature-based. Yeah. Katie, do we have some
Yes.
more questions?
Yes. Okay, so the next question is, how do you see the recent cap and trade announcement on the oil and gas facilities in Canada smoothly integrating with TIER system in Alberta, and where can brokers provide value to the market in that environment?
So I'll be honest, I don't do all that much in Canada these days. I used to do a lot, but I don't. So I'd have to go back. But if you want to reach out to me, I'm happy to take a look at it for you.
Okay, thank you. Yeah, and yeah, go on, Katie. Sorry.
Going on to the next question, unless you had something else to add, Bertrand.
No, same. I'm not super familiar with the Canada cap and trade, so no.
Okay, perfect. So the next one, can you touch on California CA AB 1305 reporting requirements?
Yeah, so I'm not a regulatory expert, but I will tell you, I think reporting around offsetting is not a bad thing, right? So for people to report what they're doing and report what the quality is of the offsets, and I'd have to. It's a long. I've read through a lot of California regulations. I've read through a decent bit of that one, but I'd have to look at exactly what you're referring to. But as far as generalized, the reporting around what offsets you're using, I view transparency as a good thing. One of the issues that the market's had has been a lack of transparency, right? And that's actually one of the things that got me excited about Vertios when I first saw it, is it was the first model that could actually take the inputs in and say, here's around where the value should be for a project that might only trade once, right? Or it might trade a couple times a year, because one isn't the same as another, right? So getting that transparency is going to be really important, you know, as far as everything that happens. So anything that requires a certain amount of rigor around how somebody's reporting, how somebody's viewing the markets, I kind of view as a good thing. And like I said, I think I was talking with, this was probably before the seminar, I was talking with Bertrand, but I think California in general has done a very good job with their environmental regulations, with the exception being that they're not an independent country. So they don't have the ability to protect their own industry. So we're seeing people, you know, with all the good intentions they might have, people are then just leaving for Texas with their manufacturing facilities. And a part of it is some of the regulations they're putting in place don't make a ton of sense either. But by and large, they're not bad. They just are not necessarily good for industry in California.
Yeah. No, and I see this I mean this bill passed in California goes pretty much in the same direction as what the EU, I think is from 2026, if I'm not wrong, where there'll be a claim, there'll be a code of claim, which is very much necessary for corporation and users to know what they can claim using carbon credits and what they cannot.
Yep.
And same VCMI, as I think published a couple of weeks ago, what they call the scope 3 flexibility, right? They say that up to 50% of your scope 3. And and we need to have a framework, because I feel that sometimes, you know, some of these companies need to have real clarity on what they can claim, what they can say after buying and retiring these carbon credits. Otherwise, this market is never going to take off.
Well, and a lot of it isn't it's not even about the regulations. They're regulating what you should be saying anyway. So we never say, we always tell people, if you're bundling offsets with a traditionally produced product, for example, that has a carbon footprint, don't call it carbon neutral, because it's going to get people's hackles up, right? Call it carbon offset, and be very transparent around what you're doing. And as long as you're transparent around it, and you're saying, here's what we did as far as engineering to reduce our energy use, to lightweight, to et cetera, et cetera, et cetera. And then we use offsets on the residual. We use these offsets. That's what you should be doing anyway, because that's where you get the most bang for your buck in environmental programs, right? And it's how you avoid the accusation of greenwashing, which, there's nothing worse than for a company than thinking they're doing the right thing and then getting attacked for it, right? And so just message it correctly, message it transparently. And from what I've seen on the regulations in California, they're basically telling you this is what you need to do. But you should be doing that anyway.
Okay. I think, Katie, we may have still time for one last question. Do we have one?
Perfect. Yes. Okay, moving on to the next one. What is Mobius's view on trend line of carbon trading platforms and the number of exchanges and marketplaces trying to engage? Will there be a core group emerging?
So trend line on market trading platforms. So if we're talking about the number of registries that are out there, I
marketplaces, exchanges, right? There's a proliferation.
We've obviously seen a lot of consolidation in global exchanges, right? So at this point, we've got ICE in the CME group, and then some smaller exchanges, LME, for example. But I think we're going to see. I'm really surprised that we don't see some kind of futures contract on carbon that ICE has come out with. I mean, they've been obviously very involved in environmental trading for a long time. They're a very well-run exchange, for profit, by the way, so they can actually invest in the stuff that they need to invest in. But they haven't come out with anything yet. The CME futures started off strong and have kind of sputtered because they're cheapest to deliver. So you get, a 70-cent offset in a market where the quality is trading for 20 times that. But I think we're going to see it for profit. I think we're going to see it consolidated, where there's one or two globally, probably one that dominates it, because there's already enough fragmented liquidity here between the projects and everything else. It just makes more sense for it to be out there. But I mean, whether it's one of the existing cash exchanges getting acquired by by one of the major exchanges, CME or ICE, I think we'll see something like that, or they'll build their own. And we're not in the business of picking winners or losers. We'll go where the liquidity is. But I think we're going to need to see that. It's going to need to be for profit. Whether it's blockchain based on day one or not, there will be a big blockchain component in it in 10 years, because it just lends itself really well to these markets. But as far as the number, I think we're going to see the number consolidate. That's not to say there won't be new players coming in, but we're going to see it consolidate. We're going to see it for profit, because it's the only way, or governmental. But the problem with the governmental is are you really going to get China and the US and Russia and India to sign on to a UN-based registry? And I think probably not. I think you'd probably wind up with Europe, Australia, Canada. That might be it. Japan and Korea would say yes, but then not do anything. China would say yes and then do the opposite. The US would just give a big middle finger and say no thanks. So I think a global for-profit exchange, such as CME or ICE, is probably the most likely outcome in 15 years. But that's just a guess.
Thanks a lot, Drew, for sharing your views. Unfortunately, we're out of time. So we're going to be summarizing like the key takeaways of our conversation on an article that we are going to publish on our website. We'll also we'll make the recording available for people who unfortunately couldn't attend. And then what else I wanted to say? Oh yeah, again, you'll be receiving, when you log out from Zoom, there'll be the survey. Remember, 8 small questions, should not take more than 2 minutes. We'll try to publish also on the articles some of the insights coming from the survey. And thanks everyone for joining. Wishing everyone happy holidays till the end of the year. Thank you very much, Drew, for joining. It was very, very interesting. And stay tuned. And there'll be more webinar coming. I think if you want to continue the conversation with Drew or myself, feel free to reach out on LinkedIn or by email.
Yep.
Any closing word? Any last thing, Drew?
No, just same as you said, happy holidays. Appreciate everybody joining and yeah, feel free. If there was something that I wasn't ready to answer today or just something that you just thought of, feel free to reach out to me if you have my contact info, or if not, just ping me on LinkedIn and I'll get back to you within a couple days anyway.
Thank you. Thank you all. Bye.
Take care, everybody.